Hi guys, welcome to Investify, where we help you grow your wealth through smart investments. Are you considering investing in the stock market, but not sure whether to go for individual stocks or index funds? The answer may depend on the state of the market. In this video, we'll explore the differences between these two investment options and which one will be a better fit for you. Get ready for an exciting ride as we dive into the world of investing and explore the pros and cons of each approach. Whether you're a seasoned investor or just starting out, this information is valuable and insightful. But let's be clear, there is no definitive answer to the question of which investment approach is better. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify. During a bull market, index funds tend to outperform stock picking. However, some argue that stock picking may be more advantageous during a bear market. Ultimately, the choice between index fund investing and stock picking depends on your individual preferences, risk tolerance, and investment goals. While it's true that index fund investing generally outperforms stock picking, it's important to remember that investing is not one size fits all. Everyone has different goals and financial objectives, so what works for one person may not work for another. At the core, it's crucial to understand the difference between stock picking or active management and index fund investing. Stock picking aims to beat the market, while index fund investing aims to match the performance of the market. If your goal is to become a superior investor, simply investing all your money in an index fund that tracks the S&P 500 won't cut it. You'll never beat the markets and won't achieve your goal. Therefore, while index fund investing may work for some people, it may not be the best option for everyone. Are you ready to take your investing game to the next level? Let's dive into the age-old debate of active stock picking versus passive index fund investing. While some investors consistently beat the market, the majority fail miserably, even in bear markets. So which investment approach will you choose? Let us know in the comments below. Interestingly, even Warren Buffett, the legendary investor, is a proponent of index fund investing. In fact, he made a bet in 2007 that an S&P 500 index fund would outperform 5 hedge funds over the course of 10 years, taking into account fees and expenses. After the wager ended in 2017, the S&P 500 index fund came out on top with a return of 12.7% per year, while the 5 hedge funds had an average return of only 3.6% per year. In light of this, Buffett advised his shareholders to stick with low-cost index funds, regardless if they are small or large investors. However, it's important to note that investing is not a one-size-fits-all approach. Your investment strategy should be tailored to your individual preferences, risk tolerance, and investment goals. So whether you choose to invest in active stock picking or passive index funds, be sure to do your research and make informed decisions. And if you're new to index fund investing, be sure to check out our video on index funds for beginners before diving in. Now it's time for some cold hard facts. Over the past 5 decades, the S&P 500 index has delivered an average annual gain of 10.4%, including reinvested dividends. Looking at the past 30 years, it's averaged 9.7% annually, while the last 2 decades have seen an average gain of 10.3% each year. These consistent returns of 9 to 10% over a long period should give you a sense of what to expect. But wait, there's more. Standard & Poor's has kept tabs on active funds managers' performance, and their latest report from last year is a real eye-opener. After 5 years, a whopping 84% of actively managed funds failed to outperform their benchmarks. And it only gets worse when you look at the 10-year time frame, with a dismal 90% of active managers underperforming. One of the reasons behind this dismal record is the tendency of fund managers to overtrade, which only compounds their investing mistakes. I suspect that amateur stock pickers might face similar issues. However, as I mentioned earlier, active management can outperform in a declining stock market. In the last decade, only 10% of active managers managed to outperform the markets. But in 2022, when the stock market was bearish, 49% of active managers succeeded in beating the markets. The reason behind this phenomenon is that active managers are better at picking winners during market downturns or shifts in sectors. Nonetheless, my recommendation to you is still to invest in index funds. In my opinion, index fund investing is a smart choice for most people, but some still make mistakes. So I want to give you some tips to avoid any missteps when investing in index funds. The first step is to adapt a long-term approach. The returns from index funds tend to even out over longer time frames of 20, 30, or even 50 years, even if there are stock market crashes. However, if you adopt a short-term approach, a single bad year can adversely affect your portfolio. For instance, in 1974, the stock market dropped by 29%, and in 2008, it dropped by 38%. So it's crucial to maintain a long-term outlook and ride out any market downturns. The second tip is to remain consistent with your contributions to index funds. It's important to continue investing, even during market downturns, as those are often the best times to deploy your money. Missing out on a year of contributions can significantly impact your overall returns. By following these tips, you can avoid common mistakes when investing in index funds and set yourself up for long-term financial success. To avoid making mistakes with index fund investing, it's crucial to have a long-term approach and consistency in contributions. Short-term thinking and missing out on opportunities during market downturns can harm your returns. It's worth noting that investing in index funds doesn't have to be an all-or-nothing approach. Many investors adopt the core and satellite approach, where the bulk of their portfolio is in the index funds. But they allocate some funds to hand-picked stocks they believe will perform well. This strategy can help balance your portfolio. If you prefer to handpick individual stocks, that's also a valid approach. But it requires more knowledge, research, and time commitment. Ultimately, understanding your investment goals, risk tolerance, and preferred approach is crucial. We would love to hear about your preferred approach to investing in the comments below. It's crucial to conduct your own research or seek professional advice. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.